Right, well, good morning, folks. Thank you very much for joining us. Obviously, first I'd like to apologise that we can't meet in person as we usually do down at the Babraham campus south of Cambridge, but hopefully it means we can get people in who haven't been to one of our budget presentations before. Obviously, we're recording this just so we can use it for the future. So if anyone objects to being recorded, then, well, you can't be heard anyway unless you unmute. If anyone objects, please log out now. Otherwise, you're very welcome and thank you for joining us. In order to keep things efficient, what we'll do is while we're going through the slides, we'll just use the chat function. So please use the chat function to raise any questions you have. We'll pause once halfway through and once at the end of the presentation to take any questions, just like we would in a real physical meeting. And there, feel free to unmute, ask questions, and it can be on the stuff we covered in the slides or anything of either that you've picked up from the budget or of wider interest. Feel free to make full use of the group here, and or feel free to chime in, just like we would if we were meeting face to face. So without further ado, we'll get underway and crack on. So the budget 2021 took place yesterday as usual, but what we get yesterday is the press releases. You know, we get the sort of not the spin, but we get the headlines. We don't get the detail, and obviously as tax people, we do love the detail. That's when we know what's really going on. So we've got the headline announcements. The actual legislation will probably not be released until the 11th of March, so until next week. So on some of this, we think we know where we're going, and some of it, we don't have all the detail yet. But please do ask questions as we go through. So what we're going to cover, and it won't be a long presentation, what we'll cover is corporation tax changes, because that's the main thrust of what came out yesterday, R&D tax credit updates, and some other measures. As ever, I'm always glad, well, I love Confluence Tax, but more than anything, I'm glad when we do a budget presentation, we don't have to do, what does it mean for a man driving a Ford Mondeo living in Basildon earning £40,000 a year? So we don't focus on all those kind of nitty gritty changes. It's very much the changes that are relevant to biotech and technology businesses. So it's quite focused in that way. Hopefully you'll find it useful. Obviously, if you've got other questions then on other aspects of the budget, please feel free to ask those as we go through. So the main change is a change in corporation tax rate. So it's an increase in the rate from the current 19% rate to 25% rate from the 1st of April 2023. So charts are flagging well in advance that it's coming. But the small companies rate remains at 19%. And then you say, well, what happens if I'm between those, in between being a small company and a large company? So if you've got profits under £50,000, your rate remains at 19%. Annual profits over £250,000, your rate is 25%. In between those two amounts, you have a tapered rate. You taper from 19 up to 25%. This is, is very familiar for those of us old enough to remember when there used to be a small company's rate and a main rate. It's all fairly mechanical as to how it takes place. I think the important message really for our client base here is obviously it's an increase in the rate. If you're loss making, it makes no odds. If you're in a position where you've got profits, then if you can claim the patent box, then it's even more important than it ever was. So patent box reduced effective rate of 10% corporation tax on patent related profits. That remains the same, and the mechanics in the rules as to how that's delivered will remain the same as far as we know right now. Therefore, the main headline rate goes to 25%, but if you can get into the patent box, you're at a 10% rate. So it remains a very valuable thing to do. And obviously, in a context, for example, of selling a company, if you've got a bunch of wealthy American acquirers looking at your company running a model, their model is now going to say, well, we're just going to assume that if we buy your business, we're going to be paying corporation tax on your profits at 25%. You want the ability to say, but if we get into patent box, it's at a 10% rate. Now, overall, I think the way the Chancellor's positioned this is to say we're going to a 25% rate. Sounds like a big jump from 19%, but in terms of where it leaves us in the G7 of the wealthiest countries in the world, it still leaves us at the bottom of the pile in terms of corporation tax rate. We're still very competitive overall as a country. I think basically he looked at things and said, where can I increase rates without damaging the competitiveness of the UK? Corporation tax is where I can make that change. So that's everything I had to cover on corporation tax rate. Now, dovetailing with that change, so that corporation tax rate change comes from 1st of April 2023. Prior to that, for a 2-year period from 1st of April 2021 to 2023, they're doing something very different and very new on capital allowances. So capital allowances, this is tax depreciation, the tax deductions you get for capital expenditure. There's going to be a first-year allowance, and we've had first-year allowances before, and the most first-year allowance they've got to was, well, you can write off the cost of buying your plant machinery. They're doing something very different, and it's a bit of an experiment. Chancellor admitted as much yesterday, a first-year allowance of 130% of the cost of your plant machinery. So spend 100 on a piece of kit, and you get a tax deduction for 130. So you get a tax deduction for more than you have spent. That's on all the usual sort of plant and machinery, so laptops, desks, chairs, machines that go ping, all that kind of thing. And then on special rate assets, so that's assets that are typically sort of integrated into buildings, then you get a 50% rate. That's an increase from the current rate. Importantly, R&D allowances are still in there as well. So R&D allowances, kit you use for R&D purposes, you can still get a 100% deduction. So full deduction in the year of acquisition for that cost. So the way to think about this, let's say you're going to build a lab. So you build a lab, you build the walls, you put in the machine that goes ping. The machine that goes ping, you get a first-year allowance of 130%. So you get an extra tax deduction for more than you spent. But on the walls themselves, they don't count as plant machinery, but you'll still be able to say, well, they're laboratory use, therefore get R&D allowances on those at 100%. So you'll probably find us as tax advisors spending more time than we have historically saying, well, which of these bits of kit are plant machinery, because you get extra tax deduction, more than the cost. And then on the R&D elements, we get 100% deduction. So it's quite a big change coming up. It's intended to drive behaviour. It's intended to say people will invest more, companies will invest more in kit for this 2-year period. And then, of course, at the end of that 2-year period from 1st of April 2023, the corporation tax rate goes up. We'll see what behaviour it drives, but certainly we'll be very keen to help you all make best use out of that change. Another change is on corporation tax losses. So under the rules as they stand at the moment, if you've got a loss from a corporation tax point of view, then you can carry that loss back 1 year. So the change is you can carry back a tax loss 3 years. So as long as you're not a company that's basically closing down, you're just doing your normal thing, you got a tax loss, you can carry it back 3 years. That tax loss is restricted. The amount you can carry back 3 years is restricted to £2 million worth of losses. And this will come in from the 1st of April 2021. Also applies to the tax loss rules on income tax and on partnerships paying income tax. So it's quite a generous change. And this is coming in, and as far as we know, it's coming in and staying in. So there's quite a few things changing on corporation tax. Got increasing rate, changing capital allowances, and changing the corporation tax loss rules. So you put all this together and you sort of weigh it all up, hence the scales there on the slides. You weigh it all up. There's a couple of big things we can see for our client base. One is on SME R&D tax credit cash claims. So if you're used to just claiming R&D tax credits as an SME cash refund from HMRC every year, those of you who have problems in the past where you've suddenly got some income and you've watched it make a difference to how much cash you can claim, you'll be used to the lower of rule. So this is where you say, how much cash can I claim? I claim that cash by surrendering losses. And the amount of loss I can surrender is the lower of either my enhanced R&D expenditure or my tax loss for the year. So we've had clients who've had to try and spread their income from an accounting point of view to try and make sure they don't have a one-off year in which they've got very significant accounting profits and therefore significant tax profits. We've seen the impact of the patent box, because the patent box sort of reduced corporation tax rate is delivered as an extra tax deduction. Clearly, if you can get an extra patent box deduction in the year, that reduces your taxable profits or gives you a greater tax loss, therefore allows you to claim more SME R&D tax credits. The new bit that's coming in with the budget yesterday is the capital allowance change. So if you can claim lots of extra things as plant and machinery at 130%, that gives you an extra tax deduction. Yeah, so you start with your accounting loss or accounting profit. If you've got patent box deductions and you've got additional capital allowance deductions, you get to a tax loss. Therefore, you can claim a hefty SME R&D cash tax credit. Hopefully that makes sense, but it's just it means a just greater disparity between what you're recognizing as accounting profit and tax profit, or hopefully tax loss, in terms of R&D tax credit claims. The other change this means is tax forecasts. So, when I started in tax a long time ago, to do a tax forecast, you basically said, well, when are you going to start paying, when are you going to start having profits from an accounting point of view? Let's multiply by the tax rate. That's what your tax forecast is. And it was very easy. You could do it on the back of an envelope or do it in one line in a spreadsheet. I think we were already used to a situation where we had patent box deductions and SME tax credit deductions that made that more complex. We've got two new things coming in now. We've got capital allowance changes, so this 130% deduction for plant machinery, and we've got the impact of being able to carry tax losses back 3 years. Tax losses have just become, tax forecasts have just become even more complex. So, if you ask us, well, here's my scenario, here's my commercial facts. When do I start paying tax? What does my tax profile look like? The answer is probably now going to be, we just need to do a spreadsheet. We just need to grind our way through the numbers to get to the right answer. Because there is just that even more reasons now for a disparity between accounting profits and tax profits. Hopefully that makes sense to people, but I'll pause there and ask if there's any questions on those sort of corporation tax changes so far, and either ask your question via the chat or feel free just to unmute and ask a question, and I'll take a much needed swig of tea. No questions at all.
Colin, can I just ask a question, please? It's Alison from iLab. Hello. So we take the view that we write off all assets under about 4 or 5K, write them off through the P&L each year. So we get the 100% deduction. Are we better now, or when we come to do our tax comp, will we actually pull those out and be able to get the 130% deduction or not?
That's an excellent question. Yeah, I think you would be, because you're getting an extra 30% deduction. I mean, what you're doing currently is saying, well, effectively they're not capital expenditure from a tax point of view. They're revenue expenditure. They haven't got what we call enduring benefit. Therefore, we'll just write them off from an accounting point of view and follow that from a tax point of view. You're absolutely right. From a pure tax point of view, you'll be better off saying, no, those are capital expenditure. We'll take the 130% deduction. Now, the nuance there is probably from an accounting point of view. Potentially, you can still say, we're just going to write those off. But from a tax point of view, you'll say, well, that's capital expenditure that we've expensed from an accounting point of view, but it's capital for tax purposes, because in our lovely tax world, what's capital is not the same as the accounting view as what's capital. So hopefully what you can get to is, we'll carry on with the accounting treatment, but in the tax comp, basically we'll say that's capital expenditure, it is plant machinery, we want the 130% deduction. I think that's certainly, and it's a very good point, certainly something we want to be doing with lots of clients, because otherwise you are missing out on an extra 30% of tax deduction.
Yeah, exactly. I mean, that's good news if that works, because we write off all our laptops, monitors, small lab equipment, everything, because it's just not worth our effort of capitalizing it. But now, we can pull those out separately. Okay, no, that's great. Thank you very much.
No problem at all. No problem. Any other questions on the corporation tax changes so far? Okay.
Sorry, Alison, the other Alison here, Alison Strutt. How does 25% compare with the US rate?
It's pretty good. It's still slightly lower than the US rate. So I think that's why the government has positioned it where it is. So it's still pretty good. And I think you've got rates are a funny thing, because people get focused on the rate. And if you're, doing a quick analysis and you go, where should I base my operations in Europe? How does the UK compare? If you just look at the rate, you'll never get the true picture, because the actual answer is, what's the tax base? What's your taxable profits multiplied by the tax rate? And that's where you actually work out what your liability is. And that's where things like patent box and those other things come in, and the capital allowance changes come in, and loss rules and things like that. So I think certainly the chance of trying to say, yes, we need to make this change, we will collect more money, but we still think we're competitive. I think from a sort of inward investment to the UK point of view, at first people might go, ooh, that UK rate's a bit high, but actually it's still in the ballpark and still at the lower end of what's in the G7, and then say, now let's do the detail. And when they do the detail, that's when you get into the finer points. Does that answer your question?
Yes, perfect, thank you.
Excellent, no problem, no problem. I mean, certainly it is interesting that, you know, the previous, Tory administrations have been very much saying, let's bring corporation tax rates down. It's just a good message. It's, you know, a good thing to the way of selling the UK, to say we've got the lowest rate by far of the major countries in the world. They're not saying that now. They're saying we're at the bottom of the heap, but we are higher than we were. So that's it means people are going to have to work a bit harder in terms of the marketing message for the UK overall. Excellent. Well, if we move on. R&D tax credits. Those of you who have been to any of our presentations before know we've banged on about this ad infinitum, mainly because had we not got the changes we lobbied for, we'd all be in a mess right now. So where we are now, R&D tax credits and the PAYE cap. So this is the cap that's coming in from 1st of April 2021, so pretty soon. It's a cap on the amount of cash you can claim under the SME R&D tax credit system, and the cap is 3 times your PAYE and national insurance. Clearly, for lots of you, that was going to be a pretty disastrous change, because you got a relatively low headcount compared to your R&D spend, therefore it would have massively restricted the amount of your cash claims. There is an exemption. And the exemption is that if you're creating your own intellectual property and less than 15% of your spend is with connected parties, then you basically can be completely exempt from the cap. So you meet those 2 tests, the cap just doesn't apply. That is an exemption, you know, we lobbied very hard for. We did lots of analysis, and thank you to all of you who contributed to that lobbying effort to sort of show the Treasury what a bad move it was going to be if there wasn't some kind of sensible exemption. The reason for the line on the picture is because, well, that's me roaring at the Treasury, because I gave them a bit of a hard time on the final bullet point here. What they were going to do, they consulted on this for ages, deferred it by a year, and said, we'll bring this measure in for accounting periods beginning on or after 1st of April 2021. They then at the last minute wrote back and said, oh, no, we're going to bring it in sooner. We're going to bring it in for expenditure on or after 1st of April 2021. We gave them a hard time and said, we're going to get in a right mess if we do this. We'll have people claiming before this stuff is law. This is contrary to everything you consulted on. So we're back to where we were. So the introduction of R&D tax credit, PAYE cap, is for accounting periods beginning on or after 1st of April 2021. So for those of you with a December year end, you're already in your 2021 year. Therefore, PAYE cap doesn't apply. So, you know, if you don't get into the exemption, it is going to apply to you. It won't apply until 2022. So we've got to a good place on that. So hopefully that's good news for everyone. Obviously, I think, you know, first things first on that is to work out, are you affected? You know, is your normal R&D tax credit cash claim more than 3 times PAYE and NI? If it is, then can you use the exemption? And if you can't, then, you know, it might be need to do a bit of thinking to see what can be done to mitigate the situation. But I don't know if there's any other comments on PAYE cap. I'll just pause there to see if anyone's got any comments on that.
Hi, Colin, it's Alison Strutt again. Last time when you introduced this cap, you said there might be a way of, you know, disallowing some of your connected parties, so you claim up to. Is that possible, or is it a measure based on your actual position and spend?
So where we are is we've got the draft law on this. The draft law has been out for a while. So the exemption is, are you creating IP? And for, I think, pretty much everyone on this call, you'll be fine on that. You are creating your own IP. And then you say, okay, to get into the exemption, I also need to have less than 15% of my spend with connected parties. Now, there's been a bit of debate about this. The way I read the law is basically it's what you claim for. So if you imagine when you put your claim together, you list all your spend, your staff cost, your consumables, your subcontractor cost. If your connected party subcontractor cost is in danger of being more than 15% of your spend, you just reduce it in your claim. You just dial that number down in your tax return until it gets to 14.99%, and then you put your claim in and you get it paid out. So you might have had to take out some of your connected party subcontractor spend, but the vast majority of your spend still goes into your claim. That's the way I read the law. That so far is the way HMRC seem to be interpreting it. We're just waiting for the actual final definitive answer on that. Certainly the David Harris, who's the senior policy advisor at HMRC, has been working on this. He sees it the way we see it. We think we're all fine on it, but we're all just waiting for the final confirmation that, as you say, Alison, you can just tweak your spend, get into the exemption, and then you don't need to worry about this cap at all. If it doesn't work like that, it's a bit odd. It's like, saying, well, you now need to go off as a company, look around your business, find all the possible R&D connected party subcontractor spend, even though you're not putting it in your R&D claim, and then show us that that number is less than 15%. I don't think we're going to get there. I think we know where we're going, but we're just waiting for final confirmation. When we get final confirmation on that, then certainly we'll be in touch with everyone just to let them know that is the case. Okay, so moving on from the PAYE cap, other matters on R&D tax credits. So there was a consultation on whether we could increase the kind of costs that qualify for R&D tax credits, to increase that to include cloud computing and data costs into claims. I mean, currently you can include software costs, but really that's software licenses, not anything where it's cloud computing or software as a service. Data costs are becoming an increasing part of people's R&D claims and need to buy in data. Currently, data you can't really say is a consumable, because the revenue view is, well, the data doesn't get consumed or transformed by being used. You just read the data and then use it for your own purposes. But the data comes out at the end of the R&D process in the same form as when it went in. You can't include it. Obviously, as you would expect, there's been a consultation. Would it be good if we expanded the list of qualifying things for R&D tax credit claims? And the industry has said yes. This has been translated into Treasury speak as there appears to be significant appetite for including cloud computing and data costs into claims. So hopefully that change is coming in. Certainly the measure, the message we gave the Treasury was, if you carry on as you are, over time, everything's moving into cloud computing. You'll end up with very little software going into claims, and you'll just end up restricting people's claims. And I think that message appears to have landed. In a wider sense, on both the entirety of SME R&D tax credit claims and R&D expenditure credit claims, there's going to be a consultation. And the consultation is to make sure the UK remains a competitive location for cutting edge research. As in, we're keeping these measures, but we're very happy to consult on, keep making sure they're internationally competitive. Now, the consultation is very broad in its scope. It's talking about, should we even introduce these credits through the tax system? Is there a better way of doing it? What kind of costs should go in there? It's basically, any either pet peeve or fundamental issue you've got with the SME or the RDEC system, as it currently stands, there's going to be a question for you that you can answer in this consultation. Consultation closes later on this summer, when we'll all be vaccinated and running around hugging each other again. So it'd be, if you can spare time from that to give us your thoughts on that consultation, that would be great. Basically, it is a sort of a root and branch review. We were involved in the previous one about 10 or 12 years ago. It will look at all aspects. And I think our experience of the previous one was, as you would expect, the very large companies and the very big R&D spenders in the UK spend a lot of time talking in very tax technical terms about the RDEC system, because that's what they claim. The SME system, can largely get missed. But so we have to make sure we shout quite loudly. Those of you who are old enough to remember, there used to be a PAYE cap on SME R&D tax credits. Not a 3 times cap, just an absolute cap. We got that removed because of the lobbying we did on the 10-year review on SME R&D tax credits. So it is a really good opportunity to get in there, and particularly to say, here's what works in other jurisdictions. Canada's got this, Australia's got that, Italy does this, that, and the other. What can we do to make sure the UK system's really working? So we will be asking for your help and your assistance on that. Moving on now from R&D tax credits. EMI share option schemes, again, another major consultation is going to take place on that. And again, this is anything you had an objection to or thought could be done better in the EMI share option scheme, please shout. So EMI share options, this is stock option schemes that basically deliver a 10% 10% capital gains tax rate for individuals, very tax efficient in the UK, widely used. It's lovely. You can agree valuations of shares with the revenue. It, from our point of view, works very well, though there are always things you can do better. They're asking some fundamental questions. They're saying, well, does the current scheme encourage recruitment and retention of staff? Do we need to include bigger companies? Because at the moment, if you've got gross assets of more than 30 million sterling, you can't be included. Should they expand the scheme in other ways? Are there other types of remuneration that would do a better job in terms of recruitment and retention of staff? So again, very fundamental consultation, big questions there, and we will be coming to you and asking for your input, and we'd be very grateful for any feedback you can give us and thoughts on that. In other news, I think there was an announcement, the sort of future fund breakthrough, they called it yesterday, an announcement of a new government £375 million fund that will invest in highly innovative companies such as life sciences, quantum computing and clean tech. But you've got to be looking to raise at least £20 million. As we understand it, it's very much, this is investment in shares in companies rather than the current convertible loan type arrangement. This is more straightforward equity. Very little, well, no detail as yet. We're just waiting to see. I think with all of these things, they can be good for some circumstances sometimes. There remains, I remain a bit concerned about, well, do you want the government on your cap table? You go and say, great, we've got this money from the government. Then you're going to need to do a reorganization. You even just, put your holding company on top of the group, reorganize the group, sell something off. What does it mean? Does the government, sort of get in the way, and are they slow to respond or are they fast to respond? So, we'll have to see how that plays out. And as soon as we get any more detail on that future fund, we'll obviously be in touch. UK listing rules. So unless you're hiding under a log somewhere, you'll be aware that the Nasdaq IPO market is quite active at the moment. And it has certain features that the UK doesn't have. Other jurisdictions, Amsterdam as well, they have certain features in their listing rules where the UK is more restrictive in terms of sort of investor protection. So Lord Hill has done a report and various recommendations, but the big ones I picked out there. At the moment, and the change they're looking at, should we be able to do dual share class structures, as in, the founders of the company can keep a share class that gives them more protection and more rights than the sort of an investor class that's more of a junior share class that just participates more in the economics and less in the sort of the voting structure of the company. Should we have the ability to reduce the free float? So the amount that's got a float on the market, take that from 25% down to 15% to align it more with other exchanges around the world. And finally, should we be more accommodating of SPACs? So special purpose acquisition companies, these are all the rage at the moment. So you list your cash shell company on the market and then go looking for something to buy. It's a much quicker way of getting on the market. At the moment, under the UK rules, there's all sorts of reasons why those don't really work on the UK market. They're working other markets. Should the UK go down this route? There was some talk in the FT this week, Financial Times, about, well, no, we want all these protections for investors. Talk from other people saying, no, we want the UK to be competitive, up there with the best of them, rather like the corporation tax rate debate, in terms of competing with other exchanges around the world. The Treasury is going to consult on what's in the Lord Hill report, but it does look like, from the messaging from the Chancellor yesterday, they like the idea of having the London Stock Exchange being up there with the best of them in terms of being able to do all these things and compete. So we'll see where that goes. I think I neglected to do a slide as well on pension reform. So there was talk yesterday as well, and there's been a lot of work. We've been involved with the UK Bioindustry Association on pension reform. Currently in the pension rules, it's quite difficult for pension funds to invest in what are perceived as high-risk sectors. There is talk about freeing things up so that a lot of that pension money that currently cannot invest in technology or biotechnology companies would be able to invest. If that happens, it'd be fantastic. We'll see where that goes. And then other news. I think we'd certainly welcome the first one, that HMRC anti-avoidance and evasion teams are going to be expanded. So certainly we feel it as advisors, trying to get answers out of HMRC, trying to get quality answers out of HMRC, trying to get HMRC's attention when you're an SME is very, very difficult. If they're going to put more people into HMRC, that'll be a welcome thing. There just seems to be a steady efflux of people out of the door of the revenue. People coming in would always be good. It means they spend time on what matters. Clamp down on some of the more aggressive stuff we see, because the aggressive stuff is what makes the rules harder for everyone. Meanwhile, the anti-avoidance industry, the avoidance industry just moves elsewhere. The other item I thought was interesting, and it didn't get much press, but you might be aware that we left the European Union, and we were signed up to the EU Interest and Royalties Directive. So this basically allowed you to make payments from a UK company to an EU member state group company without withholding tax, so without withholding UK income tax on interest and royalty payments. That's been repealed from the 1st of June 2021. We're not in the EU anymore. Why we signed up to an EU directive? I think the Treasury looked at it and said, well, from a business point of view, you've still got double tax treaties with all the main places that you might be paying interest or royalties to. Therefore, you don't need an EU directive. From a paperwork point of view, it's rather more painful, but I think it's no surprise that change is coming. To be honest, I think it's probably the first of a lot of changes where we say we have this EU directive that the UK signed up to. We're not in the EU anymore. If we make this change, does the world fall off a cliff, or does business carry on? Business carries on, therefore let's make that reform. So I think that's the first of many changes. Before I take any questions from those of you who are prepared to unmute, I'll just pick up on a couple of questions in the chat. I've just been reminded by Note as well to look at the chat for questions, and here they are. So I think just pick up on a couple of those. Peter McGowan's made an excellent point that Biden was talking about raising the US corporation tax rate, corporate income tax rate to 28%. The sooner he does that, the better, because then they'll be 3% higher than the UK, and therefore we won't be worrying about whether we look uncompetitive from a UK point of view. Sunil Shah's excellent question. When does the 170% loss relief come into play? Is it for expenditure after 5th of April 2021? Yes, the extra tax deduction on capital allowances for plant machinery, 170% deduction, that's for expenditure from 1st of April 2021 onwards for a 2-year period. So from 1 April 21 to 1 April 23. Then another question from Sunil. Will the pension rule change support investment into venture funds? If so, what kind of structures or direct equity investment into companies? Any clarity here? The answer is no clarity as yet. I think what they're looking at is freeing up the ability of pension schemes to invest in those kind of companies. Exactly how it works, whether it's kind of a fund of funds kind of approach or something like that, I don't know, is the honest answer. We're waiting to see that wind its way through. I think other questions on the future fund. If you've already had investments with the future fund, will you be able to look at the new one? I think on the face of it, I think yes, you will. The thing we always used to worry about when we were within the EU was what's called state aid. So, EU state aid, how much have you already had as a company from the UK government? Are you allowed to get any more from the UK government? And there were limits and very complex systems of working out how much aid one company was getting from one member state within the EU. Obviously, we're outside those rules now. The UK government is proceeding with caution on that, and they're introducing something which is, rather than calling it state aid, can it be called subsidy control? So controlling how much subsidy as a company you get from the UK government. So basically, those rules are in consultation. They're not in yet. the idea is to look at them and say, we need to be doing the right thing in terms of our international obligations. We don't want to be seen as being a country that's sort of just giving sweeteners to certain companies if it's going to upset sort of bilateral relations with other countries around the world. There's a lot of consultation coming on that. We are involved via our involvement with the Bioindustry Association, a lot of discussions with government on that, and we'll see where it goes. But certainly we'll keep you all posted on that. But I think that will be, how those subsidy control rules work will be one of the key considerations when you look at, well, we've already had this much money from the government, how much more can we get? If we, for example, take an SME R&D tax credit, are we also allowed to take something else? Do we count, one overall pot? Do we count multiple pots? Is there a de minimis limit that just says, well, basically you can have up to £2 million of subsidy from the UK government before you need to start worrying? The answer is we don't know yet, and we're going to see where that goes, and we'll keep you posted. So I'll now open up any more questions from the floor for those prepared to unmute and speak forth. It's gone very quiet.
On those, for the Hill report and those listing changes, do you think the UK is just trying to level up with these other bigger exchanges when they could really use this opportunity to be even bolder and go and be even more aggressive with what they could do?
I'm not an expert on the Hill report. I mean, what I've seen, it did sound, and the whole tenor of it was kind of let's level up rather than let's get ahead. It was more on the sort of let's maintain the position that London Stock Exchange has rather than let's steal a march from everyone else. Now, who knows? I mean, I'm sure some people in replying to the consultation will say, no, you're being far too timid. You should really go for it. But right now, I think it's fairly mild stuff they're planning to do just to get us into a similar position as everyone else. Sunil, yes, please ask your question.
Yeah, I mean, yesterday the Chancellor referred to this UK being a scientific superpower, and there was a consultation on the way around that. Do you know what's being proposed there?
To be honest, there's bits and pieces of funding they're talking about, but I think certainly the government has worked out that science is a great thing. They've got that message, got it loud and clear. I mean, if they didn't have it before coronavirus, they've certainly got it now. I think the detail on that is pretty scant at the moment. They're saying the right things, but I don't think there's much more detail than that. There's a few bits and pieces on what they're planning to do, but nothing major. I think, again, back to that point on subsidy control, where we used to be under EU state aid rules was the government couldn't say, okay, we just want to favour science-based industries in the UK and let's give them a lower rate of corporation tax. They couldn't do it because from a state aid point of view within the EU they weren't allowed to. Now, potentially, under subsidy control rules, they could say, well, we're going to start picking sectors. We like, this particular sector. We like genomics. Therefore, we're going to allow it to do great things, and we're actually even going to tweak the tax system to make it more beneficial. So I think they're feeling their way with it at the moment. There's a lot of discussion in government about this. We just don't have the detail as yet. Does that answer your question?
Thank you.
No problem. Okay. Any more?
Colin, it's Alison again. Nothing was mentioned about capital gains tax, and there's obviously been mutterings over the last few years that things are going to change. Do we have any inkling about what and when anything might happen?
No is the answer. I mean, capital gains tax, every tax pundit turns up before every budget and says, I think this is the year the capital gains tax is going up. And like a stop clock, at some point they'll be right, So they did announce one thing, which is that they're not changing the amount of your annual exempt allowance, so the amount of gains you make tax-free every year. They're keeping that the same. And when the Chancellor said that, I thought, oh, crikey, somewhere later in his speech, he's going to say, by the way, capital gains tax are going through the roof. And he didn't. They made no changes. And I think change is probably coming at some point, but we just don't know when. And there's no inkling, and they'll never give you any inkling because it drives so much behavior in the market. I mean, I was talking to a lawyer a couple of days ago. They've been involved in all sorts of schemes, on basically, people doing put and call options on selling shares to sell them now, before we get to the end of the tax year, because they were absolutely convinced capital gains tax rates were going up, and they haven't gone up. So we don't know. I mean, the capital gains tax is full of all sorts of funny rules and release. Entrepreneurs relief, the bit that drives the value on EMI share option schemes, that's been on the cards to be removed for a long time. The amount you can claim under that has come down from £10 million to £1 million. At some point, they might just take it away and say, it doesn't do what it's supposed to do anymore. But we'll see. The main problem the Chancellor's got is he's trying to save big money, and capital gains tax is not big money. The big things are income tax and VAT, but if you want people to vote for you, you don't change income tax and VAT. So what they've done is they've kept the income tax thresholds at the same place. Therefore, as inflation rolls on, they'll start collecting more money. They could make a lot of changes to capital gains tax. It wouldn't bring in the really, really big money they want. And also, in terms of international competitiveness, all the developed economies have a capital gains tax rate that is lower than an income tax rate, because intuitively people say, again, you make the capital gain is a long-term thing, you deserve to pay tax at a lower rate than income tax that's just every year. So given all those constraints, they kind of hemmed in, there's not much they can do, and they can't get much money out of it anyway. So I think they might tinker, but a lot of the big talk they got from the Office of Tax Simplification about let's harmonise the capital gains tax rate with the income tax rate, I don't think it's going to happen. I just can't see it, because it will be this massive signal to lots of people, don't come to the UK because you're just going to get killed on tax. So I don't think that's coming.
Okay, no, I agree. So on the EMI 10% entrepreneurs relief, do you think that rate will change at some point? Is that what you're saying?
The bit we would lobby for very hard is to make sure it doesn't change. So we'd say, do what you like on the rest of capital gains tax, leave EMI schemes alone. Thankfully, we've got a consultation where we can argue for that loud and clear, and we'll be doing that. I've just had to point out we've got 1 minute left to go. So are there any last questions before this Zoom call dies? No? In which case, apologies, folks, I have to draw it to a close there. Thank you very much. Please do send us your questions if you've got any more to hello@confluencetax.com. Thank you very much for attending, and look forward to speaking to you all soon. Thank you.
Yeah, thank you very much, Colin.
Thanks. Bye.
Thank you.